All right. Good morning, everybody. Uneducated Economist here. Actually, it's closer to the afternoon. Good afternoon, everybody. Uneducated Economist here. So in this video, we are going to be talking about the current Fed rate decision or lack of adjusting the rate, the rate moves and the Fed funds rate, and what this is going to mean for the future, at least the up and coming thinking of what it is that's going to be taking place with mortgage rates or maybe interest rates on your savings or something of that nature. A lot of times when we hear the Federal Reserve talk about what it is that they are planning on doing with their interest rates, a lot of times people say, well, that's going to be the same thing that takes place throughout the rest of the economy. So ultimately, like when people hear the Federal Reserve is going to be cutting rates, then they think about that being something that is going to bleed into, say, mortgage rates or savings rates or something of that nature. And over time, yes, that is the case. But the immediate reaction is one of that message that is being delivered, not necessarily the rate adjustment, but the message that is being delivered with it. And what is the message that is being delivered with this current Fed decision to keep interest rates steady? Ultimately, it comes from uncertainty around the tariffs and what kind of inflationary pressure that could come from that. Now, there's two ways that people can think about the Fed decision. Right? It's one of generally supporting the economy with the idea that they are going to lower interest rates to prevent unemployment from rising. Right? So now this could be one consideration of what the Federal Reserve is doing. Or people can look at the Federal Reserve and say, hey, they're trying to prevent inflationary pressures from building, so they keep the interest rates elevated. Right? So ultimately, they would lower interest rates to support the labor market, or they would keep interest rates elevated to prevent inflation from growing any hotter. Right? Now, this is generally how most people kind of look at it. Now, if you think about what it is that the Federal Reserve had communicated, even though they didn't move, right? They didn't do anything. They just sat still. They're like, hey, we got to wait and see, uncertainty, all that jazz, right? But then what was the message that they delivered with it? Was it one of worry about the labor market becoming too weak or unemployment rising dramatically? Not really. I mean, that was part of the message, but ultimately it was a message being delivered about the tariffs creating an inflationary pressure that they are uncertain about. So now we have to think, okay, so if it's an inflationary pressure that they are concerned about, how is it that the market's going to react to that? See, if they were to say, hey, we are going to be cautious of the unemployment rising, then that would have a total reaction difference coming from the market. They would totally look at that in a much different light than one of we are trying to prevent inflation. With these two different types of messages that they could have delivered, the one that says, hey, we are trying to prevent inflationary pressures from building, will cause interest rates to rise in the markets. Mortgage rates, savings rates, all this other stuff will start to move up. All the broad market, the broad economy will experience higher interest rates. If the message was delivered that says we are worried about unemployment rising, you would see interest rates begin to fall, regardless of what the Federal Reserve did with the Fed funds rate. The message that they deliver is by far the most important part. And now understanding that they delivered a message that says we are uncertain about inflationary pressures that are building or could be building because of a tariff type of economy, right? When this is stated out there, this has an expectations by the market that interest rates are going to be elevated. Again, if that message was delivered that says, hey, we are anticipating a rise in unemployment or a weakening in the labor market, you could expect that general interest rates throughout the broad economy will begin to fall, regardless of what the Federal Reserve is doing. And so when people ask, what are mortgage rates going to do into the future, I can almost guarantee, because of the message that they had delivered in the general feelings that are coming from the markets and the people out there, is that you're going to find a higher interest rate environment going into the future. Regardless, again, if whatever the Federal Reserve does, they don't have to move. All they have to do is deliver the message that is one of the feelings in which is one of worry and uncertainty and of a recession, or one of worry and uncertainty about inflationary pressures. Right? And between those two, they are able to guide interest rates in the direction in which that they are looking to move. No, most people won't see it this way. Like, most people will see it much differently, and they'll communicate in ways that says the Fed doesn't know what they are doing. They're, completely lost on the idea of what it is they need to do about these tariffs and stuff like that. And that's not right. That's not right at all. The Federal Reserve wants, needs, and has been expecting and trying to have elevated interest rates, elevated inflation expectation. They are looking for this to be continuous going into the future so that they could save their monetary policy through a higher neutral interest rate. Now, I know that's very difficult for a lot of people to understand, but to know that the Federal Reserve was in a position just a few years ago in which that the Fed funds rate was very close to zero and the neutral interest rate was right there with it. They could not stimulate the economy by dropping interest rates. It was no longer an effective tool. They switched the way that they conduct monetary policy to start using their words. Their words is the guidance that now is the main monetary policy tool. It's not the adjustment of interest rates. When you think about it, the Federal Reserve really hasn't done much since they peaked out with their Fed funds rate and then dropped them a little bit last year. But since then, they have done essentially nothing. A little bit of balance sheet adjustments and sitting on their hands. Communication about what it is that they plan on doing, or what it is that people feel that the Federal Reserve is planning on doing, is so much more impactful. We could actually see that happen at the end of 2023. I mean, there was a statement on economic projections that was given. This is famously known as the dot plot, right? So the statement on economic projections at the end of 2023 had predicted that there was going to be massive rate cuts going into the future. Didn't happen. However, the people's expectation of it did lower rates, and we saw mortgage rates drop significantly during that time. The moment that the Fed actually cut rates, they delivered it with a message that said, hey, we are very uncertain about some of the situations that are taking place out here. And initially, with the half a rate point cut, it was due to the labor market and the idea of a labor market getting weakening, which created a recessionary expectations within the people. 2 more rate cuts later, with the general idea of supporting the markets, we saw a complete reversal of where mortgage rates were going. As the Fed was cutting, mortgage rates started moving up. Again, it was because of that message that they were delivering with it. Once you recognize it in this fashion, it becomes a lot easier to understand and see what it is that the Federal Reserve is doing with their monetary policy. If you try to look for Fed funds rate adjustments as the main monetary policy tool, it'll be very confusing. It'll be so difficult to understand what it is that's happening out there because they don't use that as their main policy tool. That's not how it's working anymore. And so once we see it for this fashion, now it makes a lot more sense. And again, they delivered today's message with an uncertainty of an inflationary pressure that is coming from the tariff environment. Right? This is going to end up causing interest rates to rise. All right, we're going to keep it kind of short here today. 8 minutes into this, we got quite a few people, 171 watching. Your opinion on electricity generation plants with less of them and more demand for electricity? I don't know, man. I mean, you think about like the power plants was the main way of getting electricity, but now people can generate electricity with solar panels, and so the demand for electricity is not necessarily the same coming from the power plants, right? The electric, the companies that are producing power, as much as like, now people are using solar panels producing their own power, which throws the supply demand imbalances way off from what we had experienced back in the day. I'm going to wear my new tux to the RCL. Oh man, all-nighter. Okay, I need to figure it out, man. I still haven't got tickets. I still haven't talked to George, and I still haven't lined up a hotel room, but I got to do that. I got to do that this week so that I can make it there. I guess you already got tickets and everything, huh, all-nighter? I should give you a call and talk about that. All right, watching this channel puts understanding what's happening in easy mode. Yeah, it really does. Because once you see it from the credible threat theory, once you understand it on this fashion, a lot of people don't even they don't understand the credible threat theory. They don't understand anything that I am talking about. But then when I start describing it and explaining how it is that it works, all of a sudden they start getting a lot of clarity to it. They're like, that does make a lot of sense. This is starting to make, a lot more, it giving them a better understanding of why it is that the central bank is acting in the way that they do. If you don't know about the credible threat theory, then it's very like, obscured and wild and misunderstanding of what's happening out there. Because the credible threat theory is the most accurate way of understanding the Fed's monetary policy. And it's not my theory. It's literally, I just developed the credible threat theory because what Ben Bernanke said back in his speech of 2002, saying the credible threat of using this idea of a gold machine, right? It was the credible threat of printing up a bunch of money that he was talking about. But I said, okay, that credible threat, that's it. The credible threat of being able to do it. That's going to be so impactful going into the future, especially if they develop communication tools to push that credible threat. And man, if the Federal Reserve hasn't given many, many speeches talking about how it is that they are conducting monetary policy through the people's expectations, trying to elevate inflation expectation. But then Phillips Jefferson has two excellent speeches talking about the Fed's monetary policy, or communicating about monetary policy, and how that monetary policy is old, or how they use their words for that monetary policy. And never once does he ever talk about interest rate adjustments. I mean, he does talk about it, but not as the main policy tool. It's the communication about it. Right now, we've broken down those speeches here on this channel in a member-only live stream. You can join the channel for $1 a month, have access to all those member-only live streams that we have done, breaking down those Fed speeches, and you can understand the credible threat theory for yourself. You can go and read all those speeches. I mean, it took me about 1,000 speeches to narrow it down to about 12 to 20 of them that really explain it well. So if you want to filter through all those speeches to try and find those 12 or 20, go for it, man. I mean, I really encourage everybody to do that. Or you can just pay the $1 a month and have access to all the speeches you want that are going to explain the credible threat theory, and there's a link down in the description for that. All right. Terry Millie Boulevard? I like it. Terry Millie Boulevard? Thank you for the $5. How much does you think it going to cost to replace batteries for those solar panels? Oh, I don't know. Like, I mean, I couldn't tell you what the cost of those solar panels are going to be in the future, considering that they're probably going to be a flood, if there's not already a flood of solar panels that are going to drop prices of those things to the absolute floor. But then also the more production of batteries that starts taking place out there, again, in the future, who's to say how much demand for them or how much production is going to take place? That's really anybody's guess. I know the idea is ramping up. I know more people are moving into it. There's definitely a lot more, idea of using electricity as opposed to gasoline. Like, even a lot of the power equipment that I sell through the store here, I mean, I work at a hardware store, even a lot of the power equipment is starting to move towards batteries. All these gas powered, like line trimmers and lawn mowers, and just stuff that you would typically see a gas motor attached to, is starting to move towards electricity. So who knows, like, the demand for it is going to be huge, but then also the supply of it is also ramping up in a dramatic way too. So all right. Simon, is that JDM GM truck? Is that a JDM GM truck? What's a JDM? I'm not sure what JDM part is, but it is a GM. It's a Chevy, yes. Even smokers are going electric with e-cigs. My old man often reminded me as a kid, there are excuses to not do and excuses to do. Choose wisely. All right, it looks like you're driving a left-sided truck because of the camera. Yeah, for whatever reason, and I've switched the camera on my phone, but the YouTube app switches the camera, and I don't know why. Like, I can't get it to go the other direction, so I've tried. I don't know if it's my phone or the app or what. Dennis Starr, did you build a cabin? Japanese domestic market steering wheel on the other side. Oh, I see. Japanese. No. No, it's like The image is reversed, that's all. Powell basically just said, if you want us to cut rates, we need overall market to go lower for longer. No, they don't care about the market, right? And I understand that a lot of people are hearing that or think that. They are down to a dual mandate, two things. There's only two things that they are mandated to do: low employment or full employment, however that's described, because obviously the official numbers are not accurate, but according to them, right, low unemployment or full employment, and low inflation, low and steady inflation with, or I'm sorry, low low and steady inflation with consistent prices around 2% inflation or something like that. I forget exactly what the dual mandate is described as in word for word, but ultimately it's to keep inflation keep inflation low around the 2% with prices steady, and full employment or low unemployment, however again you want to describe it. But those are the two mandates. Right? They're not mandated to make sure that the housing market stays elevated. They're not mandated to make sure that the stock market stays elevated. They're not mandated to make sure that the bond market is, stays liquid, although they do that, right? But that's not part of the dual mandate. So understanding that the dual mandate is their only thing that they are mandated to do, right? It makes it a whole lot easier to understand how it is that they are going to adjust their interest rates. I mean, people ask me all the time, all the way up until the end of 2023 and even going into 2024, what is the Fed going to do with their interest rates? And I kept saying it doesn't matter. Right? It doesn't matter what they do with their interest rate adjustments. It matters with the delivery of the information that comes with it. And they said, okay, are they going to cut? Are they going to cut? And I said, well, they're probably going to do a symbolic rate cut to establish the credible threat. Totally happened. That's exactly what they did. They elevated interest rates up. They did some symbolic rate cuts during 2024, and now here it is discussing whether or not they are going to or not going to going into the future, because they keep it open-ended. That is the monetary policy. That's it, right? If you want to look at markets going down and saying, oh, the Fed's going to move on this, well, you're not looking at the right things. Hell, it might be accurate for you. I don't know. But I don't look at that stuff, because that's not what it is that the Federal Reserve has communicated about how it is that they plan on dealing with the interest rate adjustments, because the interest rate adjustments aren't part of their monetary policy tool anymore. They're going to communicate about it. That is the monetary policy tool. It's difficult to see it that way, I know. Right? And again, like a lot of people will argue with me about it, saying, oh no, man, you don't understand. The housing market starts to slip and they're going to bail out all their buddies. Okay, yeah, not one single word no one who says that can find a single statement from the Federal Reserve that says that. That is completely out of their own imagination. Nowhere is that stated, right? That they will bail out the stock market or they will bail out the housing market or whatever. There's nothing that's stated inside of that. Now, do they do that? Yes, that happens. I'm not trying to deny that it happens out there, right? They can give banks all kinds of loans to money that they go out there and give to all the corporations. That is essentially funneling money through the Federal Reserve into these corporations. Yes, that does take place, but that's not part of the dual mandate, and that's not part of their strategy. Man. If it was, then it would be stated inside of their strategy, right? It would be stated inside of their policies. I've read hundreds and hundreds and hundreds of speeches by the Federal Reserve. Never once do I see those statements in there like that. We're here to bail out the mortgage market or the housing market, or we're here to bail out the stock market. Even when they came up and said, hey, we're going to bail out the corporations by buying into corporate debt, they didn't even do it. They said that they were going to do it. People believed it. I know, I was one of them. I was screaming out there, the Fed's going to be picking winners and losers. They said that they were going to do it, but they didn't do it. They didn't even do it when they said they were going to do it. They don't do that, right? People believe that they do. The reactions of people are seemingly as if they had done it, but they don't, and that's what's crazy about it. Understanding that quantitative easing was a bailing out of the toxic mortgages that were happening during the Great Financial Crisis. After that, they did step into manipulation of the mortgage market to support the interest rates that were happening at the time. But again, this was creating an environment that then had the market themselves really supporting the mortgage market. They don't, like a lot of people don't see it that way, but if you have a buyer, a guaranteed buyer of a particular asset, are you going to be really nervous about finding somebody to sell that asset to if you owned it? Probably not. So you'd be very encouraged in participating inside of that particular market. Well, that's exactly what ended up happening with the mortgage-backed securities in the quantitative easing programs that had taken place. As the Federal Reserve is ramping up the buying of all these mortgage-backed securities out there, they are essentially taking mortgage-backed securities off the market. If they take those off the market, there is a demand for them coming from investors. Right? Now, granted, if you see those interest rates falling, the fixed income investors don't really want to participate in that market, but the speculators do. Right? So if they are participating in this, what ends up happening is a lot of speculation starts taking place inside of that market. So now if you're looking at it in this fashion, now you realize that the investors themselves are being, well, not necessarily the investors, but the speculators themselves are being encouraged by this idea of the quantitative easing that is happening out there. What most people looked at was the exact, okay, here we go. Let's look at it exactly opposite of this. Okay? If the Federal Reserve is there supporting the housing market by buying into the quantitative easing of it, then why is it that the housing market still seems to be incredibly elevated in price, even though they are getting out of mortgage-backed securities? The exact opposite. See, people say, okay, well, then securities going into the quantitative easing is causing the house prices to go that for a while, quantitative tightening, but yet the housing prices are still elevated. Okay? See, it creates a market perception that's happening out there, which is very much more impactful than their actual actions. The Federal Reserve has so much, like, I don't know how to say it, power of the people's perception. Is that the way to say it? Like, they have so much control over the people's understanding of what it is that's happening out there. Literally just communicating will change whatever it is that's being understood inside of the market. They don't have to do anything. They literally don't have to do anything at all. They don't have to physically do anything. All they have to do is just communicate about it, and it works. Right? This is hard. I know it's difficult for a lot of people to internalize that, because up until about 10, 15 years ago, they didn't do that. They did use adjustments of interest rates. That was their main policy tool. And it worked awesome. And everybody understood it. And those who were economists or essentially learned through academia how it is that the central banks operate, it was exactly like that. The adjustment of the Fed funds rate and how that worked into the economy. But 15 years ago, that all changed. The great financial crisis coming in and essentially, well, I mean, how long is that? It's been, how long was the great financial crisis? It's almost 20 years now, right? It's going on what? A little over 15 years. It's incredible to think, right? How long ago that really was. And since that day, people have said, man, the Federal Reserve doesn't know what they are doing. They are screwing it up. They are messing up. They have no idea, right? It's because since then, the Fed doesn't conduct themselves the way that most people have known them to do it. And, you know. All right. Uneducated economists think that is because the way information is being evaluated right now really fast in internet era, a lot more different than 15 years ago. Well, yeah, and they use it, they use it well. All right. Simon, do you think you could explain how the mechanics of how the existence of the BRICS would theoretically work to alleviate the U.S. debt path problem? Yeah, I can go over that, Brody, you bet. What time is it? 12:08. Okay, yeah, I got a few minutes here. A lot of people look at the BRICS as being a competition to the Federal Reserve or to the United States dollar as far as being a supplier of the world reserve currency. and that the BRICS nations are going to step in, abandon the dollar, and then use their own sovereign nation's currency in order to conduct their transactions that they are looking to do. This is a very common idea that is being pushed out there. Like the BRICS are like moving away from the dollar. And that very well could be true in the sense that they are making transactions outside of the dollar in order to facilitate the trade. The problem with this being is that most people look at it as like, oh man, the dollar's on its way out. Like this is going to be very damaging to the dollar. They're not going to be able to, you know, sustain themselves if people are abandoning the dollar, and they're going to fade away from it. So this ends up being like what a lot of people understand is that BRICS nations are rising and the dollar is failing, right? Now, to understand what's really happening out here is that the dollar is the world reserve currency. So when it comes to doing global transactions, the dollar by far is the most pronounced, right? I mean, the runner-up, the euro, is like a distant second. It's like way, way back there as far as how many transactions the euro does comparatively to the dollar. So understanding that even if the BRICS nations wanted to rise as a world reserve currency, or just essentially competing or moving away from the dollar, they have to be able to have two things, right, in order to compete with the dollar. Because see, the dollar has something that nobody else is doing. They have the US Treasury debt, which again, I know a lot of people look at that and say, oh man, the US Treasury debt, this is not wanted or accepted, or people are moving this US Treasury debt. That's not true. Just go and look up foreign holdings of US Treasury debt, and you're going to see there's more foreign holdings of US Treasury debt now than just about any time in history, right? There is a small drop, but still it's quite significant comparatively to what we had, you know, even last year or the years before. So understanding that the US Treasury debt is the reason why the dollar is the world reserve currency. It's because of that safe and liquid asset. Now, again, people may not find it to be safe, but it's definitely the biggest, most liquid, broadest market that you could ever possibly have in the entire world. Meaning that if you own a treasury, the chances of you being able to sell that right now, very easy. Not so much with other items out there, but the US Treasury, it's almost as good as dollars, right? In fact, it's so good that people use them like dollars. This is important to understand, because it's not just the matter of the Federal Reserve creating dollars that get used outside of the United States to do transactions. The US Treasuries are essentially what's doing the world transactions. And the reason why the US Treasuries are doing the world transactions is because there's lots of them, because the United States has gone deep into debt in order to produce that safe and liquid asset. So now here you have US Treasuries and dollars flooding the world doing transactions. That's a lot of transactions it has to perform, like a lot of them. Even if the BRICS nations wanted to do some of them, there's not enough of the BRICS nations to cover all the transactions that are wanting to be done. Only the dollar, and not even the dollar can fill that role. Like the dollar is trying to do it, but there's more demand for transactions than the dollar is even capable of fulfilling. That's why there's other world currencies out there. That's why people use Japanese yen or use, euros or use something else outside of the dollars, is because they want to do transactions, but dollars are just not plentiful enough to do it. And so now, if you are trying to create enough plentiful dollars out there to cover all the transactions that are happening, you are forcing the United States into an unsustainable debt path, because they have to produce those US Treasuries for people to use. All right? The demand for dollars start increasing. You have to flood the world with dollars in order to keep the dollar from growing too strong. If the dollar grows too strong, your exports go to shit. Right? People can't buy as much stuff from you. This is very damaging to the United States economy. So keeping the dollar suppressed is part of the game. Keeping it down so that, if you weaken your currency, other people can buy your stuff from you. But if the demand for treasuries is starting to increase dramatically so that they can do transactions, how do you provide the world with that money? The United States is in a very, very compromised position to flood the world with dollars that are being, that we can't, the Federal Reserve, they cannot continue to flood the world with their liabilities, which are dollars, right? The Federal Reserve's liability are dollars because the asset that they purchase is U.S. Treasury debt. They are sending the United States on an unsustainable debt path by trying to provide the world with the dollars. So now there is a group out there that says, hey, there's a lot of transactions that need to be done out here, and the dollar's role is not capable of doing this. There's not enough of it. You have to be able to provide even more dollars, which means that the United States has to go even deeper into debt in order to make this happen. And the Federal Reserve is like, if we do that, that's going to destroy the United States government, the United States economy, right? Their monetary system altogether. So they know this is the case. And it was just like, we can't keep flooding the world with dollars to cover all the transactions that are wanting to be done. And you think about it, it really comes down to dollar-denominated debt. People who have written contracts that are due in dollars. So all these contracts that are due in dollars, they're going to demand dollars in order to fulfill those contracts. These contracts don't have anything to do with the United States. Those are the transactions that I'm talking about. I promise, from, whatever foreign country to pay this other foreign country in dollars. That's it, right? It doesn't have anything to do with the United States except that the trade is being done in dollars. So now understanding that the Federal Reserve is in a position in which that they are not going to be able to buy U.S. Treasuries to provide the world with the liabilities, those dollars. They're going to have to figure out something else. BRICS nations can step up and say, hey, we can do a bunch of the transactions. We'll do it on our own sovereign currency. We can only do some, right? I mean, we don't go into debt deep enough to provide the world with a safe and liquid asset like the U.S. Treasuries do. So there's no way that they are going to be able to rise to the point that they are going to be able to provide a currency to fulfill all the transactions out there, but they can at least provide some pressure relief so that the Federal Reserve doesn't have to keep flooding the world with dollars. At least if they rise up, they say, hey, we can take some of those transactions off your plate. And people look at that and say, oh, that's a bad deal for the United States and the Federal Reserve and the government, and the whole time it's relieving the pressure that they have. This is like, I know a lot of people are going to look at this and be different, but if you go and you read like dollar funding stresses in China, it's a 20-page document by the Federal Reserve that talks about this exact situation. How is it that they are going to be able to provide the world with dollars and not send the United States into an unsustainable debt path is the problem that they are trying to figure out. Think about that. How is it that the Federal Reserve can continue to flood the world with dollars and not send the United States on an unsustainable debt path? They can't do it. It's not possible. Unless they start buying that of foreign assets, meaning that they are going to buy the sovereign debt of a foreign nation, put it on the Fed's balance sheet, and then print up a liability. Doesn't have anything to do with buying U.S. Treasury debt. This is the complications that is now hitting the world economy. And hardly anybody sees it this way. And I know it's because like I can't seem to find any articles talking about it. But you can go and find the information. I mean, dollar funding stresses in China is an excellent document. An excellent piece of literature that you can go and check out for free from the Federal Reserve, talking about how it is that these nations out there have all written debts that are due in dollars, and when the dollar funding becomes very stressful for them, like they cannot find the dollars, it starts creating havoc across the entire globe. Like, it makes me wonder what it is that the Federal Reserve could even possibly do to print at a pace that is fast enough to cover all those dollar-denominated debts. And the more that people want to do transactions, the more demand for dollars exists. So when the BRICS nations are stepping up saying, hey, we can do some of these transactions, that's an actual benefit to the Federal Reserve. And I know nobody's going to see it that way, but that's the case. It's the truth of it. Treasuries are losing steadily, though. In what way? I mean, and this is the thing that I find interesting, is that if you find interest rates, yields going down, treasuries are moving up, right? But if you have been buying treasuries over the last few years while yields were down, well, then when yields went up, the price went down. So yeah, I mean, if you're speculating inside of U.S. treasuries at the time when the yields were down, thinking that the price of them were going to continue to go up, then you probably got burned. But right now, you're getting a pretty decent return. I mean, it's not decent compared to what it had been in the past, but like a US 10-year treasury used to pay like what, 15, 18% back in like the early 80s, and now it's around 4%. So is it that good? No, not really. But comparatively to when it was at like 1% or less, yeah, I mean, this is a pretty decent return on a US 10-year treasury considering what it's been in the last few years. Now, again, that's not great at all. Yeah, I mean, 4% is not that great, but it's better than it was, right? And so U.S. Treasuries, I mean, that wasn't losing. That was actually winning, when you have a higher yield to it, because then you can buy the Treasury cheaper and get a bigger return on it. And then if yields fall, the price of it goes up and you can sell that asset for a profit. To me, like Treasuries right now are not a bad deal, But I don't buy them. So, I mean, I have bought them in the past. All right, what time is it? I got a few more minutes here. Everyone likes to criticize Trump, but he is something new for the people. He's something like when years ago a new artist came on the scene and delight his patrons in the Parisian cafes. I don't know. I have very little trust. I have very little trust or belief that he's going to do anything that's going to have any kind of real benefit to this economy or to the people, simply because I just don't think that that is possible. Like, even if he wanted to or believed that he could, I don't think he can, right? And so that's like, I mean, it's unfortunate for him, right? Because I really just don't see how it is that he could ever possibly do anything that's going to reverse the underlying economic forces that are at play that I have now come to the understanding that it will span over administration. So there's really nothing he can do. Right now, I mean, he can create what appears to be some pretty big upsets. And if you have ever increasing amounts of government intervention, I'm not saying that he can't create an environment that has an appearance that is that of what he has described what he wants. But the moment that government steps out of the way, boom, you lose your job, everything goes back to normal, because the underlying economic forces are still at play. You can't change those. You can't. There's nothing you can do to change that. It's like saying, like, gravity doesn't exist, and you can tell by that plane flying right there. And I'm thinking, well, yeah, once the plane runs out of fuel, gravity will definitely kick in. There's no doubt about it. Gravity exists at all times, regardless of what it appears out there. Like the plane flying is defying the laws of gravity, but it's not, right? It just has that appearance that it can because of the physical attributes of plane's configuration and the thrust behind it. Now it can give this appearance like, look, gravity doesn't exist when it comes to an airplane, but it absolutely does the moment that the plane runs out of fuel. Right? And that's the same thing that we are experiencing right now. You can have all the government intervention and subsidies and tariffs and all this other stuff that create this environment that is as if the underlying economic forces don't exist. But I guarantee you, the moment that they step out of the way, they will exist. Because they have been there the entire time, but people don't recognize it because they don't know what they are. And if it's masked over, right, and it's hidden from them, then they wouldn't be able to see it or recognize that's the problem. I mean, you think about it, just the idea of having a tariff is the sign that there is a problem within the economy. There shouldn't have to be a tariff. We should be producing the world's greatest stuff and sending it out there to the world, and the world should be sending us their money. We should not have to have a government intervention to create that environment. If we are doing that, we are directly fighting the underlying economic forces that are at play. And since most people are not trying to deal with the symptom or trying to deal with the problem, but dealing with the symptoms instead, we'll never fix it. See, the problem that we are facing right now is that we have a separation between the rich and the poor that is due to the luxurious experience that the people here have enjoyed. We worked hard here in the United States. We were a productive nation. We produced the world's greatest stuff. We sent that stuff out there to the world. The world sent us our money. We elevated our standard of living. When we elevated our standard of living, the foreign competition started to move in, started competing with our domestic manufacturers. The domestic manufacturers left for the foreign countries out there to produce in those nations. And this is what really caused the problems that we are experiencing with the inequality and the fact that manufacturing here in the United States is most likely not going to return in any kind of significant way. Are you going to find manufacturing here? Absolutely. The United States produces all kinds of wonderful things. There's no doubt about it. Huge agricultural positions. We got mechanics going on. We got all kinds of stuff. We produce wonderful products here in the United States. The problem that we face is that we import a hell of a lot more than we export, and that's not going to change. The only way to stop that is to decrease the luxurious experience that the people are facing here in the United States. It's like putting a boot on the face of humanity to prevent them from moving into luxuries, which is the problem of separating the rich from the poor and causing manufacturing to lead that domestic nation. It's like, to me, when I think about it in this fashion, I'm like, man, you can wish and hope and dream and pray all day long to do the right thing, but even the right thing can't stop the underlying economic forces. You can't. The right thing is to literally not move in, is to work as hard as you can, pay off debt, not buy anything new, not enjoy your money. Do that for generations, like literally generations. It's not going to be done in a few years. You're not going to do it in 2 or 3 or 4 years or even a decade. It's going to take generations of people living this way in order to have it come back to the United States in a meaningful way. Otherwise, it's going to be completely superficial, and the moment that government gets out of the way, boom, it's over. Alrighty, guys. I gots to go. It was fun hanging out. I really enjoy talking with you guys. Symptoms, yeah. I just wanted to read a couple more comments. What time is it? Oh, I gots to go. Okay. Everyone, oh, we just read that one. All right, Georgia Pacific, not making plywood. Thoughts? Well, I mean, the whole plywood industry, I agree. I mean, I don't know, agree. The whole plywood industry right now is in a kind of like in a very weird transition, right? Because you got two different products. You got OSB and you got plywood. And then OSB manufacturing had been cut dramatically at the end of 2019, but then it's increasing dramatically again here in 2025. So we're going to find like OSB production moving into the sheet goods, which is really going to start altering where it is that the suppliers of plywood are going to be as far as in the economy itself. If you have this overabundance of OSB, it's going to force the plywood prices down, and then they're not going to be as competitive or profitable. So you'll have issues with that. And then in that sense, you'll cut back on your production of plywood in order to increase the prices of it. All right, $1 saved is $1 earned. Vacuum is just a lack of any other material. Superior goods versus inferior goods. All righty. Okay. Can someone explain if living standards went up and inflation went up, don't we want more inflation? All right. Well, I think the living standards going up for the general population was happening when we were a production nation, right? Producing, saving. That was the type of environment that we were in that raised the standard of living. Now we have an elevated standard of living that we're trying to maintain. That's a different position to be in. Absolutely, the Federal Reserve wants inflation. They don't want deflation. Deflation is their worst nightmare in the world. They definitely want inflation for it. But the only problem is that the more inflation that you try to bring into the economy, the more separation between the rich and the poor starts to take place. When you have new money coming in, which is the inflation, right? The expansion of money and credit, prices are the results. You got to think, prices are a symptom of inflation. Inflation was the expansion of money and credit. Now, what ends up happening when people have access to money and credit, right? They start spending that money. Now you have demand. and supply. Demand increases because of the credit issuance and the money that is being deployed. Now you have supply issues when you have that higher demand, and this is where the inflation is found. So just because you print up the money doesn't mean that you're going to find inflation. It actually has to move into the demand side of things. Quantitative easing 1, 2, 3, and 4 failed to produce an inflationary scenario because most of that money ended up on the big bank's balance sheet and didn't actually move into the economy unless it was lent into the economy. So people who were borrowing that money to buy houses and stocks and bonds and all that other stuff, you saw those assets moving up, but yet the general inflation, like the standard of living inflation that we had experienced during the right after the great financial crisis, was very low. Right? I mean, I know a lot of people were like, well, look at houses, look at bonds, look at the stock market. Yeah, those things that you borrow money, those things, yeah, they did increase. But everything else was very low, and that was a nightmare for the Federal Reserve. They were looking back saying, Jesus, we just expanded our balance sheet by quadrupling the money supply, and we failed to produce an inflationary scenario that we were looking for. That's a problem for the Fed. Right? Now we have even more inflation that is happening, even more balance sheet expansion, even all this quantitative easing. And what do we end up finding from it? A huge separation between the rich and the poor. Inequality grew because of it. Our standard of living doesn't seem to increase any. I mean, the conveniences do, right? But think about it. An average job 40 years ago, if you were somewhat disciplined, you could save enough, like an average job was able to save enough to buy a house. That doesn't occur now. So our standard of living can't be more, it can't be elevated now if an average job can't cut it. We have moved beyond that. We have a huge separation. The inequality is what's now ruling this economy. You know, it's just like, how do you, like, if you don't expand the money supply, then you'll have a crashing of the economy. Everybody falls into pain and misery. If you inject more money into the system, you have more inequality. Which one do you want? All right? Because it's going to be one or the other. All right, let's read this last super chat and then I got to go. Sleazecore Trickbagger. Wow. I love the name. All right, where to find the relevant speeches? Okay, you type in Federal Reserve speeches. That's it, Federal Reserve speeches. And you can go and it will give you the most recent speeches, and you can go back as far as you need to. If you are looking for these speeches that are going to be telling of what it is that's going on, then you have to follow the Uneducated Economist. I will deliver those speeches occasionally. I will let you know what they are when they come up. I will review back onto them, or you can pay the $1 a month, become a member of the channel, and there is all kinds of member-only videos that we have covered all these speeches. So again, like, if you want to be in the know on this information, you have to follow the channel regularly. Or again, you can just become a member of the channel, the YouTube membership only portion, and you'll have access to all those speeches, all those videos that we have done. We break them down word for word so that you can internalize it and understand them yourself. Especially those ones from Philip Jefferson, talking about the communication, about monetary policy. Oh, they're so good. So good. Hey guys, I got to go. Uneducated Economist, you let me know.